briefing underway, and the overall market sentiment still very much the follow through from the Fed last night. A surprise in the fact that it was I suppose you could deem it a dovish hike, as very much priced and expected by the market. They hiked interest rates by 25 basis points, but it was the accompanying forecasts of the median dot plots, which we'll talk about and recap shortly, that shifted market expectations that possibly the Fed are not going to be quite as aggressive in their rate normalization process. Certainly not how the market was positioned. As such, you had these big movements really in the first half. I kind of define the Fed meeting when they have the kind of quarterly ones like the March, June, Sep Dec, those meetings where you have the press conference, kind of define them into two halves. The first being the actual rate announcement, the statement, the projections, and the second half being Janet Yellen. And as you can see, really the charts tell the story in that the bigger move came on the surprise on those projections, those updated dot plots that they released. The actual press conference was fairly well managed, I guess you could say, from Janet Yellen. Nothing really too shocking or surprising. She's really far too slick and experienced a central banker now for anything to not be contained, I would say. And maybe some people were looking to her to possibly start to talk it up a little bit about the Fed could respond and so on and so forth, given the dovish interpretation that was initially seen in the markets, but that didn't occur. And so we basically just held on to those prices. And so T-note sharply higher, gold sharply higher, equities rallied. So it was that whole kind of trade of imminent cycle of fairly aggressive interest rate hikes is not going to occur. At least it was against how the market was positioned, and hence the fairly aggressive nature of those moves that you saw. As you can see though, on the top left, if I just hover my cursor around that spot on that euro-dollar chart, we did actually see a bit of an extended move in euro-dollar shortly after 8 o'clock. That's when the first exit polls started to come out for the Dutch election. So before we kind of review the Fed, let's just take a look at that. And there's one chap this morning, I think a picture says it all really, rather than words, and here we go. I don't need to tell you the result. This is Geert Wilders of the Freedom Party this morning. And then this is PM Rutte this morning. Need I go further? Yeah, so it was quite a surprise in how this is really unfolded in regards to actually a much bigger victory for the existing Prime Minister than what had been anticipated. But before we really get into the nitty-gritty of the Dutch situation, let's just have a quick summary of the Fed, because I think for some of the newer guys it's important that you fully understand what exactly happened. So, as we all knew, the actual interest rate rise was very well managed, you could say, in terms of the Fed communication. You remember that chart from yesterday's briefing where the Fed, a variety of Fed speakers have basically talked up the prospect that they were going to take action in March, prompting the market to quite aggressively reprice from really low 30 or 40% probability all the way up to 100% going into the actual event itself. So as such, the market kind of moves away from that being such a focus. Then you had the statement. This is the Wall Street Journal Fed statement tracker I've got here. So I'm looking at the comparison of the previous FOMC meeting statement and the one we had released last night. And really, when you kind of go through it, it's very minimal change. There's a couple of positive things you could say about the way that the words and structure of some of the sentences have been updated. So job gains remained solid, and unemployment rate they had previously stayed near. They said little changed. They said in recent low, but they've struck that out. So getting a little bit more, you could say, optimistic about the situation. Talking about inflation, they said it's moving close to the 2% long-run objective, as we know. An interesting part, though, that Deutsche Bank specifically have picked up on, and they're putting quite a high order of significance to is the sentence here, where what they've added, or they've struck out the part in light of the current shortfall of inflation from 2%. So obviously that really is no longer the case because we're getting it pretty much at target. And they've added, the committee will carefully monitor actual and expected, and this is the part here, inflation developments relative to its symmetric inflation goal. And that's the part there, that word symmetric, that the Deutsche Bank analysts are looking at in suggesting that it seemed to prompt a debate and added some contention that the Fed is happy letting inflation run past its 2% target for a while, or in other words, letting the economy run hot. So much in a similar vein to Mark Carney and the Bank of England looking to manage expectations that he knows inflation is going to go above target, but that participants in the market shouldn't get overly fussed by it, and that the Bank of England aren't necessarily going to act immediately upon the break of that target level. So that could be contrived as somewhat slightly less hawkish in the actual statement itself. Looking at the real crux of the way that the market moved though, and why it moves so aggressively, and this table really says it all. And this is the economic projections of the Federal Reserve Board members. And the particular area here that you're looking at is the federal funds rate projections. So this line here, or this line I'm just hovering over at the bottom, that is the previous one that we had, this is the last one last night, and December was the previous projections. So this reflects then the quarter-to-quarter change. Now the market was expecting the trajectory of the Fed to potentially, given how hawkish they had been, to actually upgrade these later months, 2018, 19, longer run. There was some discussion about potentially even 2017 could be bumped up, and if the median went to 1.625%, that would be indicative of then 4 interest rate hikes, not 3, going into this year. Sorry guys, could someone close that door for me please? Thank you. So what you can see here though is that expectation did not materialize. 2017 was left unchanged. 2018 was left unchanged. That was a surprise. 2019 saw a fractional upgrade by 0.1, and the longer run was unchanged. So these were very actually dovish in regard to what majority of market participants were looking for and how then the market was positioned going in. Hence, you got an opposite result from how the market was expecting the event to occur, and hence you get quite an aggressive price movement or repricing of assets. And that's why you saw that sharp collapse in the dollar and US yields on the back of that, and consequently move higher in equities, gold, and so on and so forth. What does this actually look like? And it makes a bit more sense when you look at the dot plots now, side by side. So again, this is December and March, and you can see here, what I really want you to focus on is the bolded lines, because these are the medians. And so you can see here for 2018, although there's 3 more federal members that have moved into the fact that this is now the new norm is at this rate, rather than the bulk being down between 1.75 and 2%, the median is still the same. You can see they're still pretty widely split over 2019, but then the longer run, they're all in agreement, and really that was pretty much completely unchanged. The one dot down here is quite surprising. What this is telling you, and as we discussed yesterday, each dot is representative of one Fed official. So who can tell me who this is down here, who basically doesn't see any interest rate move for the foreseeable future for a number of years? Who's that person, do you think? Answers in the chat. Yeah, John P, you're exactly right. Kashkari, the guy who looks like the young Xavier from X-Men with a slightly better tan. That's Kashkari, and he voted, the actual vote count from last night of the voting members of the FOMC was 9-1. a majority vote, with the Minneapolis Fed president, Kashkari, the lone dissenter in favour of keeping rates on hold. This gives us a good context then because Kashkari is a relatively new FOMC voter, and so whenever he speaks, you've got to be thinking he's going to sound extremely dovish whenever he speaks, in comparison to, look how far the divergence is from the pack when in his point of view. So quite an interesting thing there to look at. This is just a reaction. Gold rising, dollar weakness, the Fed sticking to their rate projections, really just leaving things on hold. Actually in hindsight, you could say it's a bit of a stroke of genius really from Janet. She's managed to squeeze in the hike, get it underway, or at least bed another one in so soon after the December move, which, let's be honest, there was a gap of a year previously, and that gap now is shortened to just 3 months in between hikes from the Federal Reserve. And so she's got that underway, and yet she's kind of left it open so she can still move higher if need be going forward. But I guess with the lack of clarity, so to speak, on the situation with Donald Trump and his fiscal delivery and implementation risk, maybe this was the best course of action. Ultimately we still are, from a Fed at least projection, anticipating another 2 more hikes to come this year. So things to look out for in that regard will be, will that come in June? It would probably be the most likelihood as timing that people will start to focus on. Okay, quick look at the Dutch situation then, because that's the headline story this morning that you're probably reading about, and actually a bit of a surprise. And as we saw from those pictures I showed to you a short while ago, Geert Wilders losing, comparative to the polls, a very big gap between the Liberal Party and the Freedom Party in their performance. So the old traditional established parties actually becoming victorious this time round, losing a large number of seats, granted, from when they last had their election in 2012, but outperforming. It's almost the reverse, if you like, of what we've had with the likes of Brexit and Trump, the 2 global events to speak of from a political point of view, where the polls actually are wrong, but they're wrong in favour of the non-populist party, so to speak. So 93% of the votes have been counted. This number at the top actually is updated now, so it's actually 33. So Liberal Party on track to take 33 seats, and remember there's 150 seats in the lower house. The Freedom Party on track to take 20, the Christian Democrats and D66 parties on with 19 seats each. The question then is that how this typically goes forward from here is basically the Liberal Party will be given the mandate probably later today once all the numbers are finalised, but it's pretty much a foregone conclusion to then go ahead and try to form a government, a coalition government, given the fact that they were all vocal that they wouldn't team up with the Freedom Party. Again, that was in the context of if Freedom Party were to again create another populist shock and they would have come out the orange bar on top. That has not occurred though. And so now the likelihood is that the Liberal Party and with these other parties such as the Socialists, the Christian Democrats, D66 will all start talking about the formation of a government. How long that will take, history tells us, dating back to World War II, approximately 72 days. But I would guess, given the fact that the Freedom Party not performing as well as anticipated, it could be a little bit quicker than that. But I'd be still looking for a number of weeks before that gets settled and secured. The actually more important thing here, I think a lot of this is to do with almost a litmus test for the populist movement that's obviously been such a potent force in the global markets, in the political spectrum of the last 12 months, initiated really by Brexit. This is the first one where you've had a major European election kind of go against that sentiment. And of course, this leads us into the beginning of April, the end of April for the first round French elections, and then the second round in early May, of which Le Pen obviously is that next big figure that we've had pushed in the press, who's anti-EU, wants to tighten up on immigration, all these kinds of topics that we've become very familiar reading on the front page of many tabloids for a number of months. But I think this is significant because what we've had actually yesterday, and I did see a tweet last night of the odds, and the odds were already moving the moment the first exit poll came out. And when I talk about the odds, I'm talking about that of the probability that Macron wins and Le Pen loses, as far as the odd checkers average of implied probabilities from betting odds, that widened, i.e. Macron became more favourable, Le Pen less likely to win. And when I say it's a litmus test, it's quite interesting to see that when you look at someone like Donald Trump, and although he is popular in the United States, at least on balance, that is, from an external international point of view, there's definitely a view that most of Western Europe has of Donald Trump. And maybe when you talk about, it's all well and good when someone makes these campaign pledges and they talk very forcefully about what they want to do, but maybe we're starting to see the first signs of a bit of a change. And people actually thinking, well, I look at Trump and what has he done? He's done absolutely nothing in actuality terms. If I read correctly this morning, his second immigration change that he's tried to put forward, another piece of legislation getting voted down again. So, the Mexican wall, I thought that was already be finished by now, hasn't even begun. All these things, are people starting to is this populist movement starting to fizzle out a little bit? And so this will be important now to see, and I think if you're going to monitor, if you're a Euro FX trader, those opinion way polls that come out from France, I'd just be interested to see, maybe not so instant as today, but over the forthcoming days into early next week, does this Dutch situation start to then influence some of the French public thinking about their feelings over Le Pen? This is the Dutch bond market this morning. So obviously a sigh of relief, if you like. Now, let me just give you the time frame that I'm looking at here. This is basically Brexit. This is 2016 going into December. This is January. So the market really only started to get nervous about a month before the actual Dutch election. Basically what you're looking at here, the movement higher in this chart signifies the Dutch yield against the German yield getting further apart, i.e. the Dutch yield getting higher as market gets increasingly nervous about the possibility of the far right party winning. What's happened then is that as these polls have Geert Wilders fell behind PM Rutte, and then this morning this spread has started to retighten again. So just looking at some of the broader movement. And if I start to look over at the charts this morning, what you're starting to see really is a bit of a pullback on some of the extensions of these moves. I think that seems quite plausible. What will be quite interesting here in the 10-year down the bottom right-hand corner is the pivot level. Could well act as a bit of support, possibly until the US start to come in later. Likewise, the pivot level in Euro, because ultimately the Dutch situation is a net positive. If anything, on balance, it should be more of a Euro positive, albeit I say only mildly, on the French situation, because it should at least slightly lessen Le Pen's, or the market's view of a Le Pen victory, even though that is seen as unlikely in the first instance when it gets to the second round. But it seems like the market is kind of happy with how it's priced. This is why I say I think Yellen's managed the whole situation quite well, because net it's not caused a massive ramification in prices. The Fed are on track, so to speak. So yeah, respective pivot levels maybe to keep an eye on. in a lot of these markets. Likewise as well, if I look at cable here, just coming down towards the Asia Pac low, that comes in at 22.89, just getting close to that at the moment. That does also match up quite nicely with the pop that we had. Do you remember when cable spiked at around the European entrance yesterday morning, and then you've got pivot 7 pips below there at 80. So just keeping an eye on that. There you go, just testing it now as I'm speaking. Okay, a few other things though, just to wrap up the morning brief so you're fully up to speed. You've got the Bank of Japan stays the course, leaves policy unchanged after the Fed hike. You'd be remiss to think that actually there are other central banks in this world that we live in. But basically the Bank of Japan, very uninteresting. The dollar-yen pair really unfazed and not moved. Bank of Japan kept its unprecedented monetary easing program unchanged on Thursday, just hours after the Federal Reserve raised its key interest rate. The Bank of Japan said it would keep 2 key rates at current levels and maintain the pace of its asset purchases. So really nothing too interesting there. The other thing that we've got, of course, today, and just quickly to have a look at it, I'll talk about this a bit more nearer to the time, at midday when we get the Bank of England. But again, bit of a snooze fest you can be expecting from the Bank of England. Nothing greatly exciting, despite the fact that you've got the likes of the IEA shadow MPC, the Times shadow MPC, all calling for a hike. The Bank of England are nowhere near at that point of pulling the trigger, I would say, as early as now. There's a couple of charts I want to quickly show you, though, which shows that we could potentially have a rate hike towards the end of the year, though. And let's just paint the scene of the UK economy at the moment. Now, inflation is the big one. Much like the Fed, much like other central banks, that's the area specifically that's drawing attention, because during this low interest rate environment we've had post-financial crisis, inflation, despite QE, had been fairly benign. What we're starting to see now, though, is inflation is starting to pick up quite aggressively globally. None more so in the UK, chiefly because of the reason of the sharp depreciation of the pound that we saw in the immediate aftermath of the EU referendum. What's happening now then is that inflation, what we're looking at here is the year-on-year CPI, which is the benchmark measurement of which the Bank of England look at their 2% target, which is the purple line. We're pretty much right on that at the moment. Now, the quarterly inflation report we had in February suggested then that this peak will be at 2.8% towards the end of the year going into next year. So that's the inflation situation. Getting very close to target and also likely to go beyond. What does higher inflation, what's another key measurement in terms of consumers? Well, are consumers basically getting paid more to keep up with the pace of the price of goods going up? And what we're seeing here is that basic wage growth is failing to regain its pre-crisis level. Pre the global financial crisis, wage growth, that's regular pay on a 3-month average, was almost double of what it is at the moment. And if you look at it over the last year or so, really it has done not a hell of a lot. And so, or if I was to map the inflation picture over where this looks like at the moment, what essentially is happening is this is almost flatlining, whereas the inflation one is curving higher. The two are diverging from one another. What does that mean then? It means that consumers start to tighten the purse strings. You're not getting paid more, but everything that you buy is getting more expensive. Whether it's your weekly shop, whether it's a new dishwasher that you buy, everything is going up. And so what do consumers do? Quite naturally, they start to tighten their belts, they spend less as inflation rises. Let's not forget though that inflation is approximately 1% still to go till we've even got to the high that the Bank of England have said. Net then, inflation still has, prices of goods still have a long way to go up before we start to find the high point. What that meant is that in terms of consumer spending, which is obviously the big part of how our economy is driven, being heavily service sector focused, is that I think we've had 3 consecutive months of decline in UK retail sales. Most recently, we had the biggest fall since 2011. This even over the Christmas period, which more typically is a very strong period. What else is happening? Consumer confidence is also falling quite sharply. If you start looking at other metrics, such as the PMIs, which are seen as the Tier 1 data releases for the UK, then the manufacturing, construction and services that you're looking at, they have all started to tail off more recently as inflation, again, to map it, has started to increase. Yeah, so I don't want to be the Dr. Doom, Nouriel Roubini, but it's definitely not looking particularly positive for the UK economy going forward when you start to break it down. And we've not even begun to talk about Brexit and the negotiations and how they're likely to go with Europe, which you would imagine is going to be starting off at its most furthest point of compromise, i.e. no one's going to want to back down and make that first concession, you would imagine. That's only going to create a negative force for the pound, and when coupled with rising inflation that's led to these factors, which are only going to deteriorate the UK economy further, hard to fight against, you would say. Despite the dovish hike from the Fed, at least they're following track where the UK economy, the balance would be fundamentally that is going to weaken in the period ahead. Nonetheless though, if you look at the market's bets on the Bank of England, investors actually see a 20% probability of a rate increase in 2017, not a cut, because they are very much focused on the threat of this inflation aspect. Now, Mark Carney has been pretty clear that actually they have a tolerance for high inflation, i.e. they know it's going to go above target, but they're not. That doesn't necessarily mean they're going to act to counter it immediately. The problem would be if inflation just kept on going. Let's not kid ourselves. The Bank of England forecasts are just a forecast. They're not entirely accurate if history is anything to go by. That means it might undershoot, but the likelihood is, going off most other third-party research, is it could overshoot. If that does happen, the Bank of England essentially are left with no choice but to raise interest rates. Now, we're talking about a situation here when people are already tightening their belts. What if you had to deal with an interest rate hike as well for those homeowners, so to speak? You know, that would only almost capitulate the situation, and then you can start to see the difficult balance that the Bank of England have in order to manage a fragile situation but with higher inflation. So Bank of England will definitely become more interesting as the months go by, particularly as we get to know a little bit more clarity about how these first EU negotiations go, but then also monitoring how quickly inflation is rising will be telling to the Bank of England's actions later this year into 2018. Net, nothing is going to happen today with the Bank of England. No interest rate move, no change in QE in terms of the asset purchase facility or APF. The statement, I would say, will be pretty similar to the last one that we heard. There's no projections, nothing like that. They've already done their quarterly inflation report back in February. So it should be largely, touch wood, a fairly uninteresting event, I would say. Okay, aside from the Bank of England though, let's have a quick recap of other figures that are coming out, because you've got Eurozone February CPI, but this is final print, so it's not really going to move assets. So quiet morning till you get the Bank of England midday. The afternoon you do have US building permits, starts, your weekly jobless claims and Philly Fed. But given the close proximity of the Fed and FOMC announcement last night and those projections, I would imagine that this data is going to have very minimal impact on prices. Now the market is really looking to June and beyond for the next potential policy turn to come from the Fed. So data this far out is really going to have little impact when it comes to that decision making. Okay, guys, that's your morning briefing. Any questions, of course, just pop them in the chat. I'm more than happy to take them. Okay, have a good session.